You're being fed a comfortable lie wrapped in a curved line graph. The promise is seductive. Invest a little, wait decades, and compound interest will make you a millionaire. But the physical reality of your bank statement tells a different story, and this is where your progress dies. If you contribute $50 a month expecting financial magic to change your life, you are not investing. You are merely parking money. With a rate of 8% per year, after 12 months of discipline, your profit would have been approximately $26. That is not freedom. It is the price of a lunch. The central conflict no one tells you is that compound interest has an activation threshold. Below a certain volume of capital, it is mathematically irrelevant. You're trying to start an airplane turbine by blowing through a straw. The effort is real. The sacrifice of not spending is real, but the result is invisible. And it is in this vacuum of return that most people give up, believing the market is a sham, when in reality, the problem was the size of the seed. The incidence of this conflict reveals a brutal truth about building wealth. In the beginning, profitability is a dangerous distraction. If you have $1,000 invested, achieving a heroic return of 20% per year, something the best investors in the world struggle to achieve, earns you only $200. In the same period, if you had focused on earning more and contributed an extra $200 per month, your result would be 12 times greater than the market return. There's a mystery here that few notice. Why do the educational system and financial gurus focus so much on interest rates and so little on contributions? The answer is hidden in the structure of how the financial sector profits from your custody, and not necessarily from your enrichment. While you search for the magic investment for your $50, you ignore that the engine of wealth in the first phase is not the chart. It is you. The emotional weight of this phase is a silent frustration. It is the feeling of running on a treadmill that goes nowhere. You see news about new millionaires, read about interest on interest, but when you look at your balance, it seems static. This is the moment of the reality shock. Individual discipline, without the necessary volume, becomes merely deprivation without immediate reward. The danger is that this paralysis pushes you toward unnecessary risk. In desperation to turn little money into a lot, people abandon the solid strategy and chase the lottery ticket disguised as a financial asset. The first great loop of this logic is understanding why the human brain prefers to believe in a miracle of 100% return rather than accept the task of increasing its own income to invest more. If you want to understand how to break this barrier and finally make money work for you for real, instead of just watching the years pass, do not forget to subscribe to the channel and like the video. It is essential that you leave in the comments what you thought of this view on contributions, and tell us which city or country you're watching from right now, so we know where the investors who decided to leave illusion behind and seek real results are located. The next stage of our explanation will reveal the exact magic number where everything changes. The development of this conflict leads us into a gray zone that most financial educators prefer to ignore: the tactical uselessness of technical knowledge when capital is irrelevant. Imagine a Formula One driver studying aerodynamics for 10 years, but being forced to compete using a lawnmower engine. It does not matter how good he is in the corners or how precise his reaction time is. The physics of the engine imposes a ceiling that talent cannot break. In phase one of wealth building, the contribution phase, you are the engine. Your monthly contributions are the cylinder displacement. Investing $200 with flawless profitability is mathematically inferior to investing $1,000 in a mediocre asset that merely protects purchasing power. The great twist here is understanding that, in the beginning, your work outside the financial market dictates your success inside it. At this stage, the obsession with the best stock or the crypto of the week is, in reality, a form of procrastination disguised as productivity. It is easier to spend 3 hours analyzing a chart than spend 3 hours looking for a way to increase the value of your working hour. The system encourages you to focus on the micro because that generates fees, commissions, and views, while the macro, the size of your contribution, depends exclusively on your ability to generate real value in society. Here arises the second narrative loop. If the focus should be the contribution, why does the industry spend billions convincing you that you need to be a trader to succeed? The answer is simple. The market needs liquidity, and your hope of quick gains is the fuel that keeps the system turning. The investor who contributes little and trades heavily is the brokerage's favorite client, but is his own greatest enemy. The dynamic changes drastically when we cross the invisible border. There is a phenomenon of financial critical mass. While you're below the first $50,000 or $100,000, you are carrying your money on your back. Every dollar that is placed by you, the result of your sweat and sacrifice. Interest is merely statistical noise. The emotional weight of this perception is what destroys discipline. It is hard to maintain enthusiasm when you realize that, after 5 years of contributions, the market contributed less than 10% of the total value of your account. However, it is precisely here that resilience is tested. The fatal mistake is not investing little. The mistake is stopping investing because the return seems too small. The irony is that the patience required to cross the desert is proportional to the insignificance of the balance. The conflict of interest becomes evident when we analyze time management. If you spend 10 hours a week to earn 1% more return on a $1,000 portfolio, you work 10 hours to earn $10. That means you valued your time at $1 per hour. Any manual labor or simple consulting would pay more than that. The intelligent investor in phase 1 is the one who automates investing in broad indexes and spends those same 10 hours studying how to get promoted, how to start a business, or how to sell a better service. The most valuable asset of this phase is not the dollar. It is your ability to convert time into capital. It is a paradigm shift. You do not invest to get rich. You get rich so you can invest. But what happens inside the mind of someone who watches time pass and the balance not explode? A silent anger arises against the slowness of the process. This anger is what fuels the third loop, the search for the dangerous shortcut. This is where pyramid schemes and promises of 20% monthly returns find fertile ground. The individual thinks, if with $50 I will never get there, I need something that multiplies this by 100. The system knows this and designs financial products that look like opportunities, but are merely transfers of wealth from the impatient to the patient. The development of wealth requires that you accept the thesis that the beginning will be slow, boring, and totally dependent on your manual effort. The resolution of this block lies in accepting raw mathematics. If you want compound interest to begin having a voice at the table, you first need to give it an army of dollars to command. A brilliant commander does not win a war if he has only 3 soldiers. He needs battalions. Your contributions are the soldiers. The market is the general. Without soldiers, the general is merely a man shouting into the void. Building the first great block of capital is the hardest, most thankless, and least glamorous task of an entire financial life. But it is the only one that creates the foundation for the climax that comes next, when the physics of money finally decides to reverse the flow and begin pushing you, instead of being pushed by you. The transition from phase 1 to phase 2 is not announced by trumpets, but by the moment when, for the first time, the annual profit from your investment exceeds the total amount you managed to save from your salary that year. The climax of this financial journey happens at the exact moment when the physics of money undergoes a reversal of polarity. Until now, you were the slave of currency. Now, currency begins to manifest a will of its own. When your wealth reaches the critical mark between $100,000 and $150,000, something profound changes in the structure of your reality. This is not merely an aesthetic number on an app screen. It is the breaking point where the general finally receives his army. If we consider a conservative return of 8% per year on a balance of $100,000, we are talking about $8,000 in annual profit. That translates into approximately $667 per month entering your account without you needing to sell a single minute of your time for it. It is the birth of autonomy. For the first time, the work of your money equals a second part-time job that never takes vacations, never gets sick, and never complains about the boss. The first great twist of this phase is the perception that effort is now asymmetrical. For someone who started contributing $50 and saw returns of pennies, the sensation of seeing wealth generate, by itself, more than the original monthly contribution is a paradigm shock. Here, the third loop of this story closes with a disturbing revelation. Most of the wealth you will have in the future will not come from your sweat, but from growth upon growth that has already occurred. Money begins to have children, and those children begin working immediately. The emotional climax reaches its peak when you realize that if you stopped working today, the snowball would continue rolling down the mountain, getting bigger every second. The anxiety of survival is replaced by the vertigo of scale. The engine of contribution, which was the only thing that mattered in Phase 1, now begins to hand over control to the autopilot of compound interest. However, this climax brings with it an invisible psychological danger, the temptation to deviate. When the balance reaches six figures, the scale of gains and losses changes proportionally. A negative fluctuation of 10% in the market now does not mean losing the price of a dinner, but losing $10,000 in an afternoon, the equivalent of months or years of past contributions. This is where many investors collapse. The pain of seeing a nominal loss that exceeds the effort of an entire year of work is the ultimate trial by fire. The mystery of why so many wealthy people seem unhappy or paranoid about the market is resolved here. They are no longer playing to win. They are playing not to lose what time took decades to build. Wealth brings freedom, but it also brings the weight of custody. The climax is not only about accumulating dollars, but about strengthening the stomach to endure the volatility that comes with greatness. At this stage, the second twist occurs. The discovery that time, not the interest rate, is your most valuable ally. Many people reach $100,000 and feel that they have made it, deciding to withdraw the amount to buy depreciating liabilities, such as luxury cars or underused real estate. They kill the goose that lays the golden eggs at the exact moment it began laying the most valuable eggs. The climax reveals that true wealth is a matter of endurance, not speed. The investor who stays the course discovers that the next $100,000 come much faster than the first. Mathematics accelerates. What took 15 years to build in the beginning can be doubled in only 6 or 7 years in the next phase, without you needing to increase your contribution by a single cent. It is the final reward for those who were not seduced by shortcuts during the desert of Phase 1. The moment of greatest tension arises when the reality of opportunity cost becomes clear. You begin to see friends and colleagues who did not invest displaying a lifestyle superior to yours, while you maintained your discipline. The internal conflict between immediate pleasure and future freedom reaches the boiling point. However, the compound interest graph finally begins to rise vertically, and the difference between your wealth and that of those who spent everything becomes an unbridgeable abyss. The real purchasing power you accumulated is not only about what you can buy, but about the security of knowing that you are no longer a hostage to your next paycheck. Money has ceased to be an abstract promise and has become a physical shield against the uncertainties of the world. The brutal lesson of this chapter is that the climax of wealth is silent and mathematical. There are no fireworks when your money begins working harder than you. There is only a subtle change in the spreadsheet and a deep peace that emanates from independence. The financial system, which once seemed like an enemy eroding your savings with fees and inflation, now works in your favor like a current pushing you upward. The great secret of this phase is that freedom does not come from finding the perfect investment, but from having survived long enough for the volume of capital to make any good investment good enough. The general now has his battalions, and the war against scarcity was won not by a stroke of luck, but by a siege strategy that lasted years. Money, at last, has learned who the master is. The resolution of this journey is not a final destination with a gold-soaked finish line, but the acceptance of a new architecture of life. When the dust of Phase 1 settles and the traction of Phase 2 becomes your new reality, the powerful moral lesson that emerges is that wealth was never about the balance, but about the autonomy of time. The mathematics of compound interest finally stabilizes into an incontestable truth. Money is an excellent slave, but a tyrannical master. If you spent decades waiting for the market to save you without doing the heavy work of increasing your contributions, you discovered that hope is not a financial strategy. The satisfying resolution for those who understood the game is the peace of mind that comes from knowing your security no longer depends on the benevolence of an employer or the luck of a chart, but on a system that you yourself fed until it gained a life of its own. The fourth loop closes here. The discovery that the true value of reaching the first $150,000 is not what you can buy, but who you became to get there. The process of saving, increasing income, and maintaining discipline under pressure shaped an individual whom the system can no longer manipulate through the fear of scarcity. The mystery of why most wealthy people continue working is resolved by the shift in motivation. They no longer work for the dollar itself, but for the freedom to choose where to apply their energy. Money ceased to be the goal and became the infrastructure. The final lesson is that wealth is what you do not see. The purchases you did not make, the luxuries you postponed, and the time you bought back for yourself. The logical conclusion of this process disproves all gurus who promise the easy path. If you invest $50 per month and wait for the miracle, you will have only a slightly less uncomfortable old age. But if you treat investing as a non-negotiable fixed bill, if you use every salary increase not to raise your lifestyle, but to accelerate your critical mass, you will be hacking the curve of time. Discipline is worth more than intelligence in the financial market. Automation is worth more than prediction. And contribution is worth more than profitability for most of your life. The secret of the snowball is not the slope of the mountain, but the initial size of the snowball you were able to shape with your own hands before releasing it. The moral of the story is that financial freedom is a long-term contract that you sign with yourself today, giving up a mediocre present in exchange for a sovereign future. The conflict between the self of today and the self of 20 years from now is won through clarity of vision. The money promised by the system may be diluted by inflation, but your ability to generate value and the wealth you protected in real assets are the only defenses against uncertainty. The story of investing is not a story of luck. It is a story of character. It is about resisting the dopamine of immediate consumption in order to build the cathedral of independence. For those seeking this transformation, the final strategy is simple and brutal. Stop looking for the shortcut and start paving the road. Increase your contributions. Treat your investments as the most important bill of the month, and stop checking the balance every day. Let mathematics work in the dark. The lesson that Maxim and Svetlana learned in Collapse, and that the modern investor learns in Volatility, is the same. At the end of the day, what remains are your skills and what you own in a tangible and protected form. Real wealth is silent, invisible, and extremely resilient. If this explanation changed the way you see your financial future and gave you the reality check necessary to stop waiting for miracles and start building results, do not forget to subscribe to the channel and like the video. Your journey to freedom begins the moment you decide that you will no longer be a passenger of chance, Leave in the comments which city or country you are watching from and share what your contribution goal is for this year. We want to know who is ready to cross the barrier of the first 100,000 and finally see money truly work. The knowledge has been delivered. Now, the execution is yours. Remember, time will pass either way. The only choice you have is how your account will look when it reaches the end.